James Gerrish joining us now live from Shaw and Partners in Sydney. James, great to have you with us this morning, and welcome back. Happy New Year to you. Just talk us through what you are expecting, because record run again. It just seems like nothing is getting in the way of US markets right now. How do you think that's likely to feed through for us today?
Yeah, good morning to you, Leanne, and Happy New Year. Good to be back. It is going to be obviously a positive open to trade this morning. SPI futures up around 30 points. Commodity markets have continued to be strong. I guess if you think about what's happening in the US, the sectors that are driving the US market, it's all around that reflation trade, and the things that have been, that are dominant in our market. So some of the yield plays, etc., have been underperforming there, and I guess that's why our market has been underperforming that of the US. It was pretty clear to see in trade last week the significant underperformance here locally. But if our market, in terms of the financial stocks, copper bid this week, then expect some catch up, Leanne.
So just with respect to, I suppose, that sentiment in the United States, it seems overall it's getting a little more constructive, as you say. Some of those stocks that struggled perhaps last year, like the retailers and energy companies, they sort of, outperforming in the first weeks of this year, and we're seeing that rotation out of those, maybe those slower growing defensive stocks, the likes of utilities and real estate. Do you expect that to start having an effect here and translating for us here locally as well? Are we likely to see a kind of similar rotation underway?
Yeah, I think it's already started here, and it speaks to market positioning. So when markets typically get overly optimistic particular sectors or themes, or overly pessimistic particular sectors or themes. So obviously retail in Australia had a well-documented headwinds in 2017 and going into 2018 with the introduction of Amazon here, the outlook for interest rates, household debt, etc. So those things were working against retail. So the market was obviously positioned negatively towards that. When Amazon wasn't or the launch of Amazon perhaps wasn't as aggressive as some thought, then you see those positions unwind. So you see buying in discretionary retailers, etc. The same's true in oil. So the market was incredibly bearish oil from a structural standpoint, not just a cyclical standpoint, and the market gets net short oil, and then they need to recover or reposition for that trade when oil starts moving north. So I think it really comes down to market positioning. So you want to be positioning in areas where the market has been negative on and needs to change that position, or there's a catalyst for that position to change. I think that's going to be key in 2018, Leanne.
Now, of course, investors are gearing up for what's expected to be a pretty strong US earnings season. Companies expecting to report, I think, double-digit growth, but favourable guidance as well with respect to the corporate tax cuts. Do you think they will live up to the expectations and what's currently priced in?
Yeah, there's a lot of positivity priced in to this quarterly reporting season in the US. So, profits to increase around 10%, revenues to be up around 6% on a consensus basis for the S&P 500. That's some pretty optimistic expectations. But I think the market running so hard into reporting to me presents a slight risk to the US market. I know, standing in the front of what's been pretty incredible momentum over in the US market seems a little bit counterintuitive, but I think going into this reporting season there is a risk that we are likely to see some buy the rumour, sell the fact in terms of the US reporting season. So look, I think you should be a little bit cautious at this juncture. What we typically see from a seasonality point of view is the start of January, the first couple of weeks come off the back of a strong December and are generally strong. We then typically see a weaker back end of January and early part of February. So that could play out if US earnings season doesn't live up to pretty heightened expectations.
Talking of heightened expectations, I just wanted to delve into some of the commodity stocks. It is incredible to see this bull run kind of continuing for commodities. We were having quite a lengthy discussion with John Noonan earlier this morning, and he was just saying the iron ore run, I mean, it's been, it's sort of just defied all expectations. So all commodities doing well. We're heading into a number of quarterly reports for the miners this week. What can we expect from those quarterly numbers? Of course, we've just been watching the impact of the cyclone in WA and wondering whether that's likely to have any impact on those production numbers.
Yeah, well, the iron ore price just overnight came back a little bit, probably on the better than expected outcome around that. Port Hedland's reopened, etc. So I don't think there's going to be that supply issue in terms of iron ore going out of Port Hedland, so that's why the price has come off a little bit. But they've had a massive run. You know, coordinated global growth, a lower US dollar is really supporting the commodity names. But you know, we talk about the big run up in iron ore. It was a lot higher, you know, a number of years ago. It's come off a low base. It does show how obviously volatile commodities are. And if you think about the market, and I was just talking about market positioning, the market's still positioning, you know, more negatively on iron ore. I think the consensus price target this year is around $55, which is a long way below where we're trading at the moment. So, you know, the longer it stays up here, analysts are forced to upgrade earnings expectations, and the sector goes through an upgrade cycle, and I think that's what we're starting to see. You know, from our own positioning around the sector, you know, we've taken profits in the commodity stocks in recent times, looking for a correction to buy. I think you've still got to be sellers of strength, buyers of weakness in that space this year. I think this year is going to be a volatile one, Leanne.
So what in particular, can you kind of tease it out if we have a look at some of the major miners? What is your view?
Yeah, so buying BHP back in the high 20s rather than, you know, above 30 where it's trading at now, so $27, $28. You know, in terms of Fortescue, Fortescue back under $5 looks reasonable. And I think, you know, one of the things, we traded Oz Minerals recently, and they've come under a little bit of pressure in the last couple of days. We're out of those above $9. I think you'd be looking at those again, sort of low to mid 8s. One of the things in commodity stocks, they're extremely volatile. There's a lot of impacting factors that play into the price of commodities and therefore commodity stocks. So I think you've got to be active around that area. I don't think this, you know, this optimism we're seeing playing out at the moment won't last forever. And I think, you know, investors tend to extrapolate the here and now out for, you know, a long time in the future and get set on a particular theme. I think that won't be the case in 2018. I think you need to be active around your themes, active around your positioning, Leanne.
So with that in mind, the fact that we won't see this lasting forever, and with the risk perhaps of a pullback in markets, do you look at safety? Gold stocks in particular. I'm looking at the gold price, that's best weekly gain since 2016. I mean, yes, it is largely a dollar story, a weaker US dollar story, but do you look at positioning in some of the gold stocks?
Yeah, we've got Newcrest in the portfolio. It hasn't been a great one for us. We're up slightly on the position, but it hasn't added significantly to performance. You made mention of the dollar there. The gold play is simply an inverse play on the US dollar. So you've got to have a view on the US dollar, and my personal view is, you know, the US dollar is near a low, so 90 on the US dollar index should provide good support to the US currency there. So, you know, it's trading at 90.94 at last look. So we're down there. It had a terrible week last week. You know, you've got this expectation that US rates are not going to rise as fast as probably the market's positioned for, etc. So therefore that puts pressure on the US dollar. I don't think that's a longer term theme. I think this year, you know, the US dollar bases out early on in the year and then goes and has a reasonably strong year. You think about, you know, the back end of 2016, early 2017, the consensus long trade was to be long the US dollar. You know, the US dollar then pulled back around 12% that year. Right now, the market's positioned to be short the US dollar, and I think it goes against that. So again, around market positioning, if the market's short the US dollar, I think the risk now is on the upside of the US dollar, and that could put some, you know, near-term pressure on commodity prices, Leanne.
All right, fantastic. Look, James, pleasure having you on. It's great to have you back, and we'll look forward to talking to you again soon. Thank you so much.
Thanks, Leanne.
As James